What's up guys, it's your boy Kanye FX. Welcome to another beginner's guide on how to trade smart money concept. And on today's video, we're going to be talking about ICT fair value gaps. A fair value gap is a price imbalance caused by a quick or a sudden move which leaves an area where there is little or no trading activity. It's caused by aggressive buying or selling, which results in inefficient price delivery. And price often comes back to fill this gap. Fair value gaps are key ICT concepts which we are going to be using in future analysis and trade executions. Well, how are fair value gaps formed? It's usually comprised of 3 consecutive candlesticks. They are formed when market leaves a gap in between the first candle's high and the third candle's low in bullish conditions, or between the first candle's low and the third candle's high in bearish conditions. Here we can see what a fair value gap should look like when we go into the chart. So usually price will first of all create a series of 3 candles. The middle candle will form the fair value gap. In a bullish scenario now, we want to mark out the ending of the wick created before our push to the upside. And we want to mark the last wick also. Remember, according to our previous description of what a fair value gap is, the gap forms between the first candle, which is this, and the third candle, which is this. The market will create a gap where these 2 wicks do not overlap, causing an imbalanced price. In a typical balanced price, we would usually expect these wicks to form like this guy coming down, and this guy coming here. That way we don't have any gap in between these candle wicks. We can see the wicks overlapped and did not leave any zone in the middle. The market has to create a gap in between these 2 wicks. The opposite is the case for the bearish example. A series of 3 consecutive bearish candles where the ending of the first candle's wick, we mark it out, and the beginning of the third candle's wick, we also mark out, leaving a space or a gap in between the 2 wicks. When you come into the charts, you notice a lot of fair value gaps, many inefficiencies, and we can see many times where price have gone into the inefficiencies, filled it, and went the same direction. Based on our previous explanation, what do we look for when searching for good fair value gaps? First of all, we look for 3 consecutive candle formation with a clear gap. We see candle number 1 over here. We see candle number 2 here. And we see candle number 3 here. So according to our previous rules on how to find fair value gaps, what do? We mark out candle number 1's highest wick. And we mark out candle number 3's lowest wick. Then we draw our zone. One thing we should always remember is whenever we mark out a bullish fair value gap, we're anticipating price to trade upwards and come back and test the bullish fair value gap. Many times price will just tap the top of the fair value gap and start trading higher, but sometimes price can come into the fair value gap and trade higher. In this case, price eventually traded into our zone and started trading higher from here. If we were to take a trade from this fair value gap, what we're going to do is place our buy from the beginning of the fair value gap, put our stop loss at the end of the candle wick that form the fair value gap, and take profit aiming for the next high. So remember, whenever we have a bullish fair value gap, we're anticipating price to come back into the fair value gap and continue trading higher. The opposite is the case for a bearish fair value gap. After price traded into this fair value gap, what happened? We see price came and would have given us a perfect setup, and from there we see price continue trading higher. One thing you should note when using fair value gaps is you do not just come into the market and start trading off any random fair value gaps. Apart from the fact that we expect market to come back into this fair value gap, there are other factors that are going to be put in place in order to take a successful buy or sell position from a bullish or a bearish fair value gap. I'm going to be teaching those other criteria in the next video, so you guys should make sure you stay tuned and have a lovely day. God bless.